Hello everyone, this is Sridharan from Wallet Wealth. So in this video, we are going to talk about what is SIF and how it works and whom it is suitable for. So basically SIF is nothing but a specialized investment funds. So which is basically everybody might be aware of what is mutual funds, PMS and AIF. So this is actually a kind of a flexible mutual fund for informed investors. See, primarily how SIF is different. So SIF can use long short strategies, derivatives, and then they can do a tactical allocation and then advanced hedging. These are the four ways the SIF can function. So primarily when we are talking about derivatives and hedging, so these things are not applicable in a normal mutual funds, wherein these strategies can be applicable in the PMS and AIF in a bigger way, wherein this is considered to be a kind of a light PMS where the minimum ticket size is 10 lakhs. When we are planning to invest in PMS and alternate investment funds, the ticket size is minimum 50 lakhs and 1 crore for PMS and AIF. So whereas here it is actually the minimum investment is 10 lakhs, but it is above mutual fund. Basically mutual funds you can invest as low as 5,000 rupees as a lump sum and as low as 500 rupees as the minimum investments for SIP. Here in this SIF, the fund manager will be able to take a tactical allocation. They will be able to take long calls and short calls. So that means they will be able to adjust their returns based on the market fluctuation, assuming if the market is actually in the short time, actually if there is a fall in the market, your short sell will be providing you an alpha, because that protects the investments, wherein if the market is bullish on the long term, that will actually provide you a negative return on short calls and positive returns on long calls. That will probably provide you a little lesser than the 100% exposure on the equity, wherein if the market falling down by 20%, 30%, then probably this will protect the this one because of the short call that the fund manager is basically being taking. And here they uses the derivatives to provide an alpha to the investor, but as per the SEBI regulation, they can take only 25% of exposure to derivative. So maximum 25% of derivatives can be exposed. The rest of the money should be invested in the long-term equity. And they can also use an asset allocation method where they will also be using a hybrid strategy to hedge the portfolio against different asset classes. So these are the key advantages of SIF, and this SIF is suitable for investors who are seeking a different product or basically wanted to have an additional exposure from the core mutual fund portfolio. So the mutual fund portfolio will form a core part of the portfolio, and the satellite allocation can be given to SIF. That means one should hold at least 3 to 5 years to generate a better alpha in terms of getting higher returns in the SIF. So the possibility of higher returns is possible in SIF, but one has to hold minimum of 3 to 5 years time horizon, and this is suitable for very well informed investors and not for the beginners. So hope you all understand the basics of SIF. Thank you.